Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two growth-focused AI tech stocks to consider buying on the dip amid the market pullback and holding for the long term. And those two stocks are ServiceNow and Vertiv. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these two stocks, I just want to go over the broader market to give a sense of why investors might want to start nibbling at some beaten down tech stocks. So the stock market had ripped higher over the last 2+ years, and the overall bullish backdrop remains in place. That is tech and broader corporate earnings, so S&P 500 earnings growth. The outlook remains really positive heading into the back half of 2025 or beyond the fourth quarter reports that we've just seen. So the guidance for first quarter, and the Fed is still set to lower interest rates in 2025. That said, no matter the broader bullish backdrop, selling was inevitable when growth stocks, you had AppLovin and Palantir skyrocket over 200+% between the election of President Donald Trump in early November and early last week. So between November 4th and February 18th, stocks were skyrocketing, and there was just going to be selling. It was just inevitable. So Wall Street dumped all things kind of AI, including soaring nuclear energy stocks during the week leading up to NVIDIA's release. So that was, I'm recording this Thursday afternoon, so that was after the bell on Wednesday. So everything from Bitcoin to Constellation Energy are attempting to find their footings near those post-Trump election breakout levels. NVIDIA's report was strong, yet as I record this, it's down around 4%. So nothing crazy. It's not like it's tanking or anything like that. In fact, the stock is kind of just chopped around for the better part of 6+ months. It's currently hovering right below its 50-day moving average after testing its 200-day somewhat recently. So it's not like there was some massive sell-off, and the stock chopping around is not a bad sign. Overall, it's actually a positive sign that it wasn't some massive sell-off, because the report itself was really strong, and it shows that the AI and broader growth tech trade is still in play. It just now we can set up a better buying opportunities for tons of great stocks. So as I record this, the Nasdaq's down around 1% through roughly midday on Thursday. The Nasdaq still has not touched its 200-day moving average or even really tested since the summer. It is, however, already at some of its most oversold RSI levels since those summer swoons. And it is possibly a time to start dipping your toes into some stocks if you're a longer term investor or even a trader, because downturns are often the best time to buy stocks. CNN's Fear and Greed Index, which is kind of a contrarian indicator that a lot of traders and investors use, has fallen from roughly neutral levels last week to extreme fear of 22. So it was at 47 last week. Now it's at 22 today. So when investors are broadly afraid, that's kind of a good time to jump into the market. Obviously, no one knows what's going to happen right around the corner. We could see a bigger flush lower, but there's little doubt that the euphoria has kind of evaporated quickly, which is when the smart money and investors with longer term outlooks might want to start nibbling at some of their favorite investing class tech stocks. So the two stocks we're looking at today, as I said, are ServiceNow and Vertiv, and the first one of those we're going to dive into is ServiceNow, which trades on the ticker NOW, so just now. So ServiceNow provides cloud-based digital workflow services and solutions to enterprise customers. It aims to help automate digital workflows and with a product portfolio designed to help boost workflow automation across areas like IT, HR, and beyond. Its customers are scattered throughout really every facet of the economy, from healthcare and technology to financial services and consumer products. It has and already will continue to benefit from the constant wave of tech innovation that forces businesses from all industries to adapt and spend heavily to thrive and keep pace. It boasts partnerships with the likes of Microsoft and many others. And the company, though, over the last several years has transformed its business and its pitch to clients in Wall Street via artificial intelligence. It now boasts that it is the AI platform for business transformation, helping organizations of every size in every industry put AI to work for their people. So that's kind of the broad transition they've done over the last few years. they've really tried to incorporate AI throughout their business model, and we'll get into some of the results that it's helping a lot. So their Now platform is a cloud-based foundation that enables all of their various products, and they've tried to work AI into all of their various enterprise business offerings for all their clients. So that's been able to generate more growth, but we'll get into it. The broader business, even before this generative AI push that everyone's trying to get into and ServiceNow has successfully rolled out in the last few years, has been really impressive. So ServiceNow's offerings and successful subscription model for businesses, which is about 95% at the moment. Last year was 97% of the revenue, has led to a really impressive run of over a decade straight of 20% or higher revenue expansion that took it from around under $400 million in sales in 2012 to about $11 billion, so $10.9 billion in 2024. Its 2024 revenue jumped 21%. That said, its GAAP earnings, so the non-adjusted earnings, did slip last year after a massive jump in 2023. So that's just coming up against a difficult to compete against period. But overall, its adjusted earnings climbed significantly as well. And I wanted to just note before we jump into what's next that the company that it now has roughly 2,100 customers with more than $1 million in annual contract value, which is up 12% year over year. So it's growing its bigger clients. And they have nearly 500 customers with more than $5 million in annual contract value, which is up 21% year over year. So they're getting those bigger clients, which is always a good sign for businesses of all, especially in the tech world. So they're showing that their ability to drive these AI products to these bigger businesses are actually paying off, which is a good sign, especially since once these companies get kind of in the mix, the subscription businesses continue to generate revenue going forward. During the quarter, ServiceNow continued to advance a bunch of their offerings, and they said they rolled out 150 new generative AI innovations for autonomous responsible AI to the ServiceNow platform. That said, though, it did provide somewhat disappointing guidance in late January, so it reported on January 29th, but it tried to make up for some of that disappointment by authorizing another $3 billion of share repurchases. And we have seen their earnings revisions kind of stagnate recently. So for 2025, it was up a little bit in the first half of last year, and how it's slowly declined, and its 2026 outlook is down a little bit as well, which we'll get into that is part of the reason the stock has fallen. That said, overall, its 2025 earnings per share estimate's only down about 0.6% over the last 60 days, with its 2025 outlook down just 1.3%. So it's not like after the report, its earnings outlook just tanked. So that's why it might be worth diving into the stock, which we'll get into a little bit more. So looking ahead, we're calling for another 19% revenue growth this year and another 19% revenue growth this year. So under that 20% threshold, but still roughly another 2 straight years to add on top of the decade plus of 20% top line growth to get all the way up to about $15.4 billion. And then on the bottom line, we're calling for 17% adjusted earnings growth in 2025 and then a 20% bump in 2026. So solid growth in the bottom line as well. Overall, the stock has climbed roughly 1,200% in the last 10 years to quadruple the tech sector, roughly. But it has cooled off in the last 3 years. It's up just 64% versus tech's 47%. And then it's up 25% in the last 12 months versus tech's 20%. So the cool down recently is a good sign. And we'll touch on a little bit. Its valuation is kind of the concern and why investors have pulled back a little bit on ServiceNow. The stock is now down roughly 20% from its late January peak, so right before its earnings release, and it's trading around 22% below its average Zacks price target. It's also worth noting that stock split. It's a stock split candidate and has not announced a stock split, but it's trading for around, at the moment, $945 a share, which is kind of prohibitive, not just for retail investors, but traders and various other people. So it's worth putting just kind of on the radar that it's possibly going to announce a stock split at some point. That's purely speculative, but when stock prices get up that high, it's a possibility. Its valuation level is certainly holding back the stock. It's trading at 14 times forward 12-month sales versus tech's 6 times, and its PEG ratio, which factors in its longer-term earnings growth outlook, is at 4.2 versus tech's 1.7. So still, it's pretty pricey on the valuation front, which is why The stock has kind of been recalibrated a bit, but as we can see, its top and bottom line growth is there, and investors have been willing to pay up for the stock for a long time. Overall, Wall Street's still pretty positive. So of the 39 brokerage recommendations that we have, 31 are at strong buys, with only one sell there in the mix. At the moment, it did find buyers at that 200-day moving average, which it tested for the first time since the summer. It could be, by the time you listen to this, it could on Friday or whenever you listen to this, it could have kind of slipped back. The market's in flux at the moment, but overall, it's trading 20% below its highs, and its business is continuing to boom as its clients love its new AI offering. So certainly worth putting ServiceNow on your radar amid this broader market downturn, especially these big pullbacks from strong AI names. And now we're going to move on to Vertiv, which is a stock I've actually talked a bunch about on this podcast. It's a stock I own personally and a stock that I think is a great long-term investment, and that trades on the ticker VRT. It's a picks and shovels investment in the massive expansion of AI data centers and other compute-heavy innovations such as cryptocurrencies. It helps the computing power needed to drive the modern economy and the AI boom run as smoothly as possible around the clock. Overall, its hardware, software, analytics, and ongoing services portfolio is focused on power, cooling, and IT infrastructure. Its product categories include critical power, thermal management, racks and enclosures, monitoring management, and beyond. Overall, though, Wall Street has fallen in love with the stock because its ability to grow kind of no matter what companies eventually dominate AI. Its job is kind of just work in the background, helping make sure everything is running as smoothly as possible at all times. It even is working with NVIDIA, so the kind of the leader in the AI world, to help solve behind-the-scenes challenges facing the rapid expansion of AI and its sustained growth. Therefore, it makes sense that 14 of the 17 brokerage recommendations that Zacks has for Vertiv are strong buys. It posted another impressive quarter in Q4, which are reported on February 12th. The CEO continued to talk about how they're going to be able to grow along these AI super cycles. And they also said the CEO said it was confident in their growth trajectory, and they reaffirmed their 5-year financial framework that they presented back in late November. So that's always a good sign that amid all of these worries about DeepSeek and a broader slowdown, that Vertiv is reaffirming its outlook of a 5-year growth plan that Wall Street loved back in the fall. So that's a great sign. The company grew its adjusted earnings per share by roughly 60% in 2024. Its strong earnings per share growth came on top of 230% expansion last year. It grew its revenue by about 17% in 2024, which came on top of 21% expansion in 2023. Looking ahead, we're calling for another 15% growth in both 2025 and 2026 on the top line to get to about $10.6 billion next year. And then we're calling for 26% adjusted earnings growth this year, another 24% growth next year. So really impressive double-digit top and bottom line growth for Vertiv. The stock has ripped about 530% higher in the past 2 years. This tops NVIDIA, which is up around 475% during that run. The stock's now up around 770% in the last 5 years, blowing away tech, which is up around 135%. This performance does, however, include a 33% pullback from its peaks. So it's trading around $97 per share as I record this, which is 43% below its average Zacks price target. The sell-off has also cooled off its valuation level, so it's trading 40% below its highs in terms of forward earnings and almost in line with tech at 26.5 times forward 12-month earnings. And its impressive long-term earnings growth outlook helps it trade at a 44% discount to tech with a PEG ratio of 0.9. So Vertiv is certainly another one of these AI stocks that has taken a big hit recently amid the sell-off, which was due, as I mentioned up top. That's worth putting on your radar as we head into March. The stock at the moment is trying to find support and climb back above its 200-day. It is not gotten back above that level yet as I record this, but it's trading at some of its most oversold RSI levels over the last several years. And even if it fades a little bit further, if you're a longer-term investor, you don't need to try to time it that precisely, but certainly no one can tell you exactly what's going to happen in the near term, but it's already down over 30% from its recent peaks. So Vertiv, another name definitely put on your radar at the moment. And that does it for me in this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.